Hey guys, it's Sasha. A few minutes ago, the FDIC officially shut down First Republic Bank, making it the second biggest retail bank collapse in history. And of course, immediately after being shut down, First Republic Bank is being immediately handed over to JPMorgan Chase at a massive discount, with JPMorgan taking none of the risk and getting paid $13 billion on top. This means JPMorgan Chase will now hold over 10% of the total deposits in the United States, which is technically illegal. More on that later. The biggest ever bank collapse was Washington Mutual in the financial crisis in 2008, and the third and fourth biggest collapses happened just a few weeks ago. It was Silicon Valley Bank and Signature Banks collapsing one right after another. So we're very much seeing a banking crisis that is on par with the biggest out there in history, and we now have 3 banks that have collapsed in the space of just a few weeks. All through last week, First Republic Bank was apparently trying to do whatever they could to survive, but the share price was indicating that the bank is in dire straits and there's no way out. Trading at $147 just 3 months ago, shares of First Republic Bank collapsed to $3.51 as the markets closed on Friday, and they are now down below $2, heading towards zero as I'm recording this video. On Friday, the FDIC told big banks that there would be an auction for First Republic Bank and bids had to be submitted by the end of Sunday, eerily reminiscent of what happened with Silicon Valley just a few weeks ago. On Sunday night, we heard news that a few of the banks were thinking of carving up First Republic Bank. There was a lot of discussions taking place, who wanted which bits. But that sounds like a load of hard work, and we all know that no regulator wants to do hard work. And literally 3 hours into Monday, in Washington, D.C., according to Washington, D.C. Time, which is where the FDIC is based, we get news that JPMorgan is going to acquire the whole thing. It sounds like the regulator really went to town and seriously taking the time to review all the bids and weigh up all the pros and cons, because the decision was made so fast, it would be physically impossible for a single member of the FDIC to actually read the submitted bid documents, let alone make a fucking decision on the back of it. But I am sure there is absolutely no corruption, no backdoor deals involved whatsoever. No, that would be bad, right? Because there is a law in the United States that dates back to the 1993-1994 financial crisis, commonly known as the Reagan-Neal Interstate Banking and Branching Efficiency Act. You can look it up just like I did just now, this morning, and under Section 101, Part A to B, it says nationwide concentration limits. The board may not approve an application pursuant to paragraph 1A if the applicant, including all insured depository institutions which are affiliates of the applicant, controls or upon consummation of the acquisition for which such application is filed, would control more than 10% of the total amount of deposits of insured depository institutions in the United States. And this bid references paragraph 1A, and paragraph 1A talks about acquisition of banks, which is exactly what's happening right here. So the law says that no bank can take over another bank in the United States if after the takeover they would control over 10% of all insured deposits in the United States. It's to stop monopolies and to stop abuse. JPMorgan has $2.3 trillion in deposits as of the end of Q1 this year, and the latest data from FDIC suggests that this means JPMorgan is already at the 10% mark roughly, which means that according to this law from 1994, they should not be allowed to acquire First Republic Bank at all. And apparently other banks, including Bank of America, were interested as well. But the FDIC made this decision in approximately 10 seconds, because that is exactly how long it takes to do proper due diligence in the second biggest bank collapse in history. And this morning, on Monday, May 1st, all branches of First Republic Bank will reopen as JPMorgan. Now, there is a funny clause further down in that same law, which is, I am guessing, what allows this acquisition to technically happen. Because paragraph 2, subparagraph D, does say that sometimes an exception can be made, and it gives 2 reasons why the regulator might let a bank go over the 10% mark. The first seems to be a technical reason that I don't think applies, but the second says the deal can be approved if the acquisition is approved by the appropriate state bank supervisors of such state, and the standard on which such approval is based does not have the effect of discriminating against out-of-state banks, blah blah blah. So basically the rule says no bank is allowed to go over the 10% of total deposits to prevent a monopoly. Good. But the regulator or whoever can just arbitrarily decide that this law does not apply in this specific case and allow a takeover anyway, which in no way whatsoever massively encourages a disgusting degree of corruption and bad intent. So in this case, the regulator thought long and hard for about 3 hours in the middle of the night on Sunday and decided that this is exactly the sort of scenario where JPMorgan should be allowed to break the law and acquire First Republic Bank without any due diligence being done whatsoever. The interesting question is, how good is this deal for JPMorgan? Because here is a statement from the FDIC about this acquisition. And it says, blah, 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 JPMorgan will acquire First Republic Bank and all its assets, and all 84 branches in 8 states will reopen as branches of JPMorgan Chase this morning. All depositors of First Republic Bank will become depositors of JPMorgan Chase Bank. There is a total of $229 billion in assets and $103.9 billion in deposits. But look down here. The FDIC and JPMorgan Chase Bank National Association are also entering into a loss share transaction on single-family residential and commercial loans it purchased of the former First Republic Bank. The FDIC as receiver and JPMorgan Chase Bank National Association will share in the losses and potential recoveries on the loans covered by the loss share agreement. So the FDIC will share in the losses that JPMorgan might incur after buying First Republic Bank, which is pretty nifty for JPMorgan, because they're clearly buying the assets for cents on the dollar already, because the bank is distressed, the share price is basically at zero, and the regulator is using a legal loophole to allow JPMorgan to buy the bank even though it is technically illegal. But that is not enough for greedy banksters. So of course, the FDIC will also foot the bill for any losses from this acquisition going forward so that JPMorgan carries no risk whatsoever, only upside. What the actual fuck? The resolution of First Republic Bank involved a highly competitive bidding process and resulted in a transaction consistent with the least cost requirements of the Federal Deposit Insurance Act. This is complete bullshit. I'm sorry, the highly competitive bidding process could not possibly have been properly concluded with any level of reasonable due diligence in a time frame measured in minutes. It would be physically impossible to hold any sort of assessment of the bid, to actually read the bids with any sort of analysis or actual due diligence of any kind in the space of just a few hours on a Sunday night. But wait for it, here is the kicker. The FDIC estimates that the cost of the deposit insurance fund will be about $13 billion. This is an estimate, and the final cost will be determined when the FDIC terminates the receivership. So the FDIC is going to literally pay up $13 billion to cover the losses and the deposits in the bank. This will be standard procedure if the bank was, going under. That's what the FDIC is there for, and not being rescued. But here, it is being rescued. It is literally being acquired. It is being handed on a silver platter to JPMorgan, and on top of that, the FDIC is going to pay $13 billion indirectly, but pretty much to JPMorgan. The bank is acquiring $103.9 billion in deposits and is getting a 13% bonus on top from the taxpayer. And yes, FDIC money is the taxpayer. Before the inevitable comments pointing out that technically it's not the taxpayer because, FDIC is an insurance policy that protects U.S. deposits and is funded by regular contributions from the banks. I do know. And where do you think do the banks get the money that they then hand over to pay for these insurance payments? From the magic money tree? No, the money comes from the fees and charges that the banks charge their customers. So yes, regular everyday people paying their monthly fee for their bank accounts are literally paying JPMorgan $13 billion as a bonus to congratulate them for buying First Republic Bank. I guess there was no possible way that the FDIC could have spent maybe just a little bit more than a few minutes thinking about this and seeing if perhaps they didn't actually need to hand over a fuckload of money on a silver platter to the biggest bank in the country while selling them a distressed asset at a discount already. Now, you might remember that on March 16th, a load of the biggest banks in the US deposited $30 billion into First Republic Bank, apparently to try and prop it up. So out of the $229 billion of assets and $103 billion in deposits, $30 billion is literally sitting there as deposits from the big banks, including $5 billion from JPMorgan themselves because they put in their own money. And so did Bank of America, Citigroup and Wells Fargo. Goldman Sachs and Morgan Stanley put in another $2.5 billion and a bunch of others put in $1 billion each. So what the actual fuck happened in 6 weeks? Apparently, First Republic Bank lost $100 billion since the start of the banking crisis because depositors saw Silicon Valley Bank collapse and Signature Bank collapse and decided to withdraw their money. It doesn't help that First Republic Bank is another clown bank that tailors to a very narrow, high net worth clientele, which basically means the bank run is way more likely because there is absolutely no balance to their asset portfolio. There's a very small, concentrated number of clients, and flight risk of capital is excessively high. People who keep millions or billions of dollars in a bank are more likely to move the money than a regular person with $200 sitting in their checking account. But I guess the regulator fucked up once again, and once again there will be no accountability. There's nobody to blame. Nobody will have to answer any questions as to how this was allowed to happen. How banks are allowed to have massively risky commercial strategies that can blow up very fast because of massive imbalances in their portfolios. How is it that these banks are regulated and the regulator should know of this risk and understand it, and yet does exactly nothing until the game is up? Again, the bank could have been placed in receivership and the FDIC could have taken actual time to do their due diligence, but that would invite scrutiny. It would invite people to actually look at what's happening. It would mean the process has to be somewhat public. But here, a dirty deal can be done behind closed doors late on a Sunday night and nobody has to know how the decision was made. But of course, we already knew that this is exactly how it was going to go down because remember Washington Mutual? The biggest bank to ever collapse in 2008? Well, you're gonna love this. Just before the collapse in 2008, JPMorgan Chase was apparently looking to acquire Washington Mutual. I know, what a fucking coincidence! So JPMorgan was looking to acquire Washington Mutual as part of their Project West. But along comes the financial crisis, and it would be incredibly stupid not to take ridiculous advantage of a financial crisis, right? So we get an orchestrated bank run on Washington Mutual, then the FDIC steps in and shuts the bank down, and you know what happened then? I bet you do. Well, the FDIC immediately handed everything over to JPMorgan Chase, of all the people. Well, everything except unsecured debt and equity claims, because you know those things actually have risk. Funny how exactly the same thing happened today. After this happened, Washington Mutual actually filed a lawsuit against FDIC for alleged unjustified seizure and unfair low sale price to JPMorgan Chase. Because of course JPMorgan Chase back then bought the bank at a massive fuck-off discount while taking on none of the risk in very murky circumstances. But JPMorgan Chase promptly filed a counterclaim, and this case was basically buried never to see the actual light of day. And in the 15 years since, nobody has said anything. So the FDIC and JPMorgan thought about it and said, why don't we do this again? And here we are.